What can we expect to see in the stock market in the next couple of years? In this video, we're going to be looking at some of the data to help us see whether or not the S&P in particular is going to have a strong financial year, or if it's all going to come down crashing and burning.
No! God, please, no! No! No!
As I have just mentioned, this is specific to the American market, but it is important to note that anything that happens to the American market tends to happen to the European markets 1 to 2 years down the line. Before I do my analysis on the financial market's health, I'm going to quickly show you two opposite opinions from two renowned analysts. The first of the two being from David Kostin, Goldman Sachs chief US equity strategist, and the second being from Peter Berezin, saying at the end of 2025 he expects the S&P to be down at 4,100.
Joining us here at Post 9 this morning, Goldman Sachs Chief U.S. Equity Strategist David Kostin is with us. DK, welcome back.
Nice to see you. Very good to see you.
You've been asked a lot about your target the last few days, and the first thing you generally point to is earnings growth, right? As opposed to a multiple expansion.
So in the last couple of years, the PE multiple for the S&P 500, Carl, has gone from 17 to about 22. So huge multiple expansion. We think about the market going forward, it's mostly going to be earnings growth in terms of our analysis. And so earnings growth, we're looking around 11% earnings growth for 2025, 7% earnings growth in 2026. Now, that's because most of the companies trade around fair value. Not necessarily all companies, but in aggregate, pretty much close to fair value at this level, around 21.5 times multiple. So the earnings growth, and the point that's worth emphasizing is that the relative earnings growth between the Mag 7 and the rest of the market is narrowing dramatically. So put some numbers on that. You've got the Mag 7 have earnings expectations for this year of around 33%. That's going to be relative to the rest of the market around 3%. So in aggregate, you'll get around 8% for this year. Next year, that's going to narrow to around sort of 5 to 6 percentage points. And that is the reason why the expectation we have is that the Mag 7 will outperform, but by a much narrower amount. And again, put some numbers around that. 2 years ago, it was 63 percentage points of excess return. Right. This year, it's around 22 percentage points. Next year, probably 4.
And that growth slowing is greater than the rest of them catching up, in other words.
Correct. Well, it's a little bit on both sides.
It is?
The diminution in the growth rate for the Mag 7 and a little bit increase in the growth rate for the rest of the market. And that, in aggregate, we'll be around 11% for next year.
Peter, we were talking in the break, you, Mandy, and I, about your end 2025 S&P 500 target. You got 4,100. Why so bearish?
Well, it's not really that bearish. To get to 4,100, you just need to assume two things. One, you need to assume that the forward P multiple on the S&P drops to 17, and that earnings estimates decline by about 10% from current levels. That's all it takes. Now, if you look at the average forward P multiple between 2015 and 2019, a period which didn't include a recession and which encompassed most of Trump's first term, the average P multiple then was 16.8. So I'm saying that in a recessionary scenario, because I do think a recession is likely next year, we'll get to 17p. That's not particularly challenging, nor is the assumption of a 10% decline in earnings estimates challenging when investors currently expect earnings to rise by close to 15% over the next 12 months. Usually during recessions, earnings estimates fall by closer to 20%.
What's going to lead to that earnings recession, Peter, if that's what you're calling for? Is it further rationalization and the market losing their religion over the AI narrative and the CapEx story as well? And NVIDIA, of course, serves as a reminder of the equity concentration risk.
I mean, that'll be part of the story. You know, it's interesting. If you look at S&P 500 free cash flow per share, that's actually down 3% since the end of 2021 because so many tech firms have been splurging on CapEx. Now, of course, some of those firms will succeed, and all those chips that they're buying from NVIDIA will prove to be useful, but there'll be losers, and those losers will probably have to write off that CapEx. If there aren't any losers, by the way, then you could have a very competitive market for AI, and those monopoly profits will materialize won't materialize either, and we'll have write-offs as well. But I think the bigger issue, the one thing that I really worry about next year, is what happens to global growth. I think we're going to see a recession. The trade war will compound that, but simply the fact that monetary policy has been so tight, that monetary policy operates with lags, that will also be an important driver of the coming economic slowdown.
So there you have it. There is two well-renowned analysts saying two complete opposite things. It is important to note that truly nobody can predict what actually happens in the next year in the financial market. The only thing you can do is to really look at the data and make your own thoughts and opinions on what you've seen. So now let's do that for ourselves. Starting off here, looking at global liquidity, we can see that we are currently just coming out of the bottom of a cycle, which essentially means we can expect the global economy to start printing more and more money over the next couple of years. The only way you can really combat such a problem is by owning assets, and stocks and shares can actually be seen as valuable assets in these times. In terms of a house, for example, the value of that property will always be its intrinsic value, i.e. how much the actual house is worth. Despite this, it is the complete opposite for actual money, as this just goes off how much value we give it ourselves, and this can be manipulated due to factors such as inflation. So now we are going to look at a PE ratio, both normal and the Shiller's PE ratio for the S&P. This helps us determine whether or not there's much growth priced into the S&P currently, or if it is currently looking overvalued. As of right now, we are on a 29.55 PE ratio on the normal, and on the Shiller's PE ratio, we are currently just below 40. So what does this tell us? For me, this is telling me that the S&P is currently heavily overvalued. Looking on a smaller scale here, we can see that in 2000 we had the massive crash where we reached a Shiller's PE ratio of 44. In 2021 we had a Shiller's PE ratio of 38.58, and currently at the previous peak we have been at 38.52. So looking off this, it is clear to see if we match previous patterns that we will see a bit of a recession potentially this year. I don't want to say recession, as that is really bearish, but I do think we are going to see a lot of bearish action within the S&P this year in general. That is of course dependent on the pattern reoccurring, as we are seeing similar P ratios to December 2021. Ideally, we want to see the Shiller's PE ratio around the mean here. So again, it's kind of difficult to gauge this right now, but it does look as if we are in overvalued territories. So now we're going to have a look at the GDP for the United States. This has expanded 2.7% year on year in the third quarter of 2024. As far as GDP goes, I don't think this is a concern at all. This looks really healthy. If this does start to fall below the 2% mark, this could signal a weakening in the US economy. But with it being at 2.7%, I think that this is relatively safe for now. But there might be potential signs of it starting to slow down. We will have to wait for the data in Q4 for 2024 to see whether or not this is actually starting to slow. Now, moving on to inflation rates. The annual inflation rate for the US rose for a second consecutive month to 2.7% in November 2024 from 2.6% in October. This was in line with expectations. The rise was partly influenced by low base effects from last year, with energy costs declining along with gasoline and fuel oil, and natural gas prices increasing by 1.8% compared to 2%, with inflation for food also accelerating to 2.4% versus 2.1%. I think it's safe to say that inflation rates within the United States has reached a healthy level currently, especially when comparing it to 2022, where inflation was at 9.1%. Ideally, we would like to see this go a bit lower, as it is still slightly high, but for me, this is nothing to be worried about. So now we're going to have a look at the interest rates. Fed officials judge that upside risks to the inflation outlook has increased due to a recent stronger than expected readings on inflation and likely effects of potential changes in trade and immigration policy. At 4.5%, interest rates are still relatively high, especially when comparing it to the past. Of course, it's nothing on the 1980s, but ideally we would want to see this to drop, but it's not an awful place for it to be. And with the Fed saying that they are only going to revise this twice, potentially over 2025, they've also priced in a lot of growth for this next calendar year. So whilst this would be better around the 3% mark and lower, it's still not something to be massively concerned about currently. So now we're going to take a look at the unemployment rate for the United States. Currently it is at 4.1%. Comparing it to its past, this is not actually that bad at all. With its peak in 2020, of course, being around 15%, that is, of course, a bit of an anomaly, but typically this is known for being quite a low unemployment rate. This unemployment rate can suggest that the economy is growing at a stable rate. One factor which is obviously set to have a huge impact on the American market is, in fact, Donald Trump. With him taking office in late January, what can we expect him to implement? From cutting taxes to raising tariffs to eroding central bank independence, the US President-elect Donald Trump has made a wide range of economic promises, many of which threaten to blow up the fuel inflation. Despite Trump's brave plan, there is a lot of forces acting against what he wants, of course, with there being rumours of Trump firing the Fed. Despite Donald Trump's assurances that he will not seek to remove Federal Reserve Chair Jerome Powell, there is little doubt that the US President-elect aims for greater influence over the Fed's decision-making. Such influence could drive long-term interest rates, damaging the American economy. And of course, Donald Trump publicly came out to say that he wants the US economy to own Bitcoin. This was, of course, countered by the Fed, as Jerome Powell said that the Fed is not allowed to own Bitcoin, and Trump, of course, wants to change the rules around that. One rumour as to why Donald Trump actually wants to own Bitcoin is to offset the US debt. The US government has accumulated significant national debt, and concerns of inflation are persistent. Some see Bitcoin as a potential solution or alternative to devaluing fiat money. By promoting Bitcoin or other decentralized assets, proponents believe it could reduce the reliance on printing money, thus limiting inflation and possibly creating a way to manage the debt. This position in Bitcoin wouldn't just help Donald Trump and the US. It would actually harm the Chinese economy. The idea is that buying Bitcoin would hurt the Chinese economy, particularly in relation to China's large holding of US Treasury bonds. So China holds over $1 trillion worth of debt. The primary reason for this is to maintain the value of their own currency relative to the US dollar and manage its trade surplus with the United States. I won't go on for this for too long because it's not the topic of this video, but it is very interesting. If you do want to see a full video on this, let me know in the comments and I will make one. Getting back to the topic at hand, it is clear to see that Donald Trump wants pretty much a reform of the economic system in the United States. It will be interesting to see whether or not he actually manages to implement what he is proposing. But overall, the good ideas should offset the bad ones. So I don't think it will affect the US economy, such as the S&P, too much, but it will be interesting to watch, of course. So looking at the US national debt, we are currently at $36 trillion, and that's just kind of ridiculous. This, in my opinion, is the biggest threat to the US economy right now. It will be interesting to see what exactly Donald Trump can implement to put a stop to this stupid exponential growth of debt. Of course, debt isn't specifically a bad thing for the US economy, but if it is exponential like this and there is no way of combating it or at least growing the economy, then it is, of course, a bad thing. Luckily, right now, the economy is showing signs of growth, but it's still not ideal. So when dividing the total debt by the amount of active working people in the United States, if they were to all pay this off in their tax currently, they would have to pay $223,000 each in tax alone. So it's pretty clear to see that tax is never going to pay for the US debt. So it will be interesting to see what exactly happens with this figure. So what are the key takeaways and conclusions for this video? I think that we might see a slight bear market in the next 6 months. This mostly being due to the fact that looking at the Schiller's P/E ratio and the normal P/E ratio for the S&P 500, it does seem to be very overvalued currently. Despite this, GDP, inflation, interest rates and unemployment all seem to be stable. One thing to definitely keep an eye on is the impact of earnings reports coming up. If we start to see a decline in these earnings reports, we might start to see a bear market sooner rather than later. If not, this bear market could definitely be delayed, but I do think it is very inevitable currently. This isn't the end of the world, don't get me wrong, but we will see a slight correction, and it will be interesting to see if we do manage to claw it back by the end of 2025, which in my personal opinions, I do think that we will see the market climb back up from this decline. Whether it's as early as then, I don't know, but only time will tell. I hope you have enjoyed this video and found it useful. If you have, please do leave a like, comment and subscribe. Let me know in the comments what you think. Will we see this bull market continue, or will we see this inevitable bear market happen anytime soon? Thanks for watching, and I'll see you in the next one.